Hello again, everyone. Welcome back. In this technical analysis of the stock market video, I call it deja vu because we're seeing some similarities right now to the kind of rally that happened back in March. And we've had a pretty strong push in here. Let's talk about that. We're going to look at the Dow Industrials and the S&P 500 today, and then look at some interesting comparisons. I've been hearing a lot of talk recently that says, oh, well, if the S&P retraces 50% of its move down, it's never gone back and taken out its low. Well, I've got some real doubts about that. And of course, they're quoting data back to 1947. Well, the S&P number one, the S&P 500 didn't even begin until 1957. So, and then there was like an exception to, the bear market that happened in 73, 74. Well, I'm hearing a lot of comparisons to the 70s these days. All right, let's take a look here at the weekly charts. The Dow, the S&P, and the NASDAQ composite. The Dow was up 957 points. The S&P up 135. The NASDAQ up 330 points. Okay, so big strong moves, big continuation in here. Let's go back to the home screen and take a look at, we're going to look at the Dow. And you can see the low that happened in June put the Dow, if I go from intraday high to intraday low, the Dow was down 19.8%, and now we're getting this strong counter trend. The other interesting thing is, look at the kind of counter trend moves that we'd had with the first thrust down. Right here, retraced over 61.8%, probably close to 70%, then collapsed, okay? Then we look again and take a look at the next leg. Down. Same kind of thing, almost exactly to where we are right now, almost right about 70% or so. Okay, now we may not be done. Maybe we're going to continue to push a little bit higher, and I'm going to talk about that in a minute. Let's look at the Elliott wave picture. When we look at this picture right here, this has been my preferred count, that we are in a leading diagonal pattern down, that we've had 5 waves complete for intermediate wave 1 in the ends of the middle of June. Okay, 5 waves down. And where are we now? In this counter trend, we're back up in this reversal zone, as I like to think of it, in the 50 to 61.8%, especially on a wave 2. Yeah, could we continue to push a little higher? Absolutely. We've got a gap up in here that was created between May 4th to May 5th. We're talking about these numbers in here to the high, 34.1, let's call it 34.118 to the high in here of this wave 2. So yeah, this could provide some resistance in here, but we're going to be watching the price action to see if it reverses. Now, let's talk about this leading diagonal pattern. There are pluses and minuses to what I see with this pattern, okay? Wave 4 overlaps wave 1, check. You need to have that in a leading diagonal, okay? And the same thing on an ending diagonal. And, wave 2 and wave 4 are supposed to be zigzags. It's very subtle, but it definitely shows up in here on the wave 4, and especially if you drill down into the 195 and 130-minute charts, etc. Now, this one, wave 2, is a zigzag, but it's a double zigzag, a WXY for the wave 2. The other fly in the ointment is this wave 3, and a contracting this wave 3 should be less than wave 1. It's not. It's longer than wave 1. So that's a little bit of the fly in the ointment. Now I'm going to talk about an alternate view that I've got, but I'm going to wait and talk about it on the S&P 500. So let's go ahead and take a look at the S&P right now, because the same alternate holds for both the Dow and the S&P. Okay, here's the S&P 500, and at the low in June, it was down 24.5%, intraday high to intraday low in here on the S&P 500, and now we're in this counter trend move back up. Let's take a look at the Elliott wave picture. Very similar to the preferred count that I've got, that I've been holding anyway. I may be shifting it to the alternate, we'll see. But right now, this is what I've got as the leading diagonal down. It's got the same flies in the ointment in here in terms of the, wave 3 being longer than wave 1. But visually, it looks like a leading diagonal pattern. It just visually fits very, very well. I like this throw over for wave 5 also in here. We got the overlap between 4 and 1. So right now we're pushing higher, just like in the Dow. We're in this reversal zone of 50 to 61.8% of wave 2 versus wave 1 down. And we're up in here 42.71 to 43.08, 42.71 to 43.08, and watching for a potential reversal. So that is where we're at. Now, what is the alternate count? The alternate count is a leading expanding diagonal pattern. Now, in Elliott wave, when it comes to motive waves, like 1, 3, and 5, it can only be two things. It can only be an impulse or a diagonal. But when it comes to the diagonal, there are two variations, either contracting like I just showed you over here, or an expanding pattern. Now, when I look at this expanding pattern, it almost fits all the rules much better, and it fits with what we're doing. And also, it's really interesting, if you go back, look at the Bible, Elliott wave principle, it talks about the expanding leading diagonal. This form appears to occur primarily at the start of declines in the stock market. And I find that really, really interesting because that's exactly where we are. Okay, so now here we've got wave 1, wave 2, we've got the overlap, here's wave 4. And again, what are we doing? We are watching for the reversal back down. Wave 5 should be longer than wave 3. Now, where does this become invalid? If for whatever reason this market continued to push higher and wave 4 went beyond the end of wave 2, well, then there's no way that this could be a leading diagonal pattern because that's not allowed. Wave 4 cannot end beyond the end of wave 2. Okay, but wave 4 needs to be longer than wave 2. Wave 3 needs to be longer than 1. Wave 5 needs to be longer than 3. So right now, there's a lot of things I like about this kind of pattern, and I'm seeing the same thing on the Dow Industrials. Okay, now I want to look at some indicators. I'm going to take a look at the McClellan Oscillator. Let me pull that up and just show where we are. We are in severely overbought territory. We're sitting up here at plus 231 with the close on Friday. Well, we seem to be clustering and bouncing around up in this area very much like what we were doing when at the end of March into the beginning of April. Now, the same thing happened in May, and look how severe we got in May, and then the bottom just fell out. I mean, my gosh, it went all the way down here to the lowest, one of the lowest readings anyway of the year. Of course, January had a little bit lower reading in terms of being severely oversold. But here we are, similar to March, so we're keeping an eye on that. Let's take a look. Let me go back to my cursor, shrink this down. I also want to take a look at the VIX, and let me pull that up real quick. You know, the VIX has basically been cratering lately, but the other thing I noticed, I mean, here we are, 2 out of the last 3 days closed below 20, very similar to what happened in the cluster of closes back over here at the end of March into the beginning of April, okay, right near the top of that counter trend move. The other thing I like about this, I mean, this is very, very strong. We also have a very strong move in here, not quite as steep, but it looks similar in terms of what it did and how it acted. Now, this has definitely taken a little longer than the way this has played out, so we'll see. If we somehow find some kind of little bottom in here, it would fit with finding a top like I just talked about over the next coming days, or I would say 1 to 2 weeks. Maybe we chop around and finish off this move sometime here in the second half of August and reverse back down. The timing seems kind of interesting as we lead into one of the worst months performance-wise for the stock market, which is September. Okay, I also want to look at, in terms of things that are lining up with, March and sentiment extremes, that type of thing. Let's take a look at this that I came across this week. This the American Association of Individual Investors Sentiment Survey. The bullish sentiment is above 30% on consecutive weeks for the first time since late March. This just came out on Thursday, I guess it was. Since late March, the lowest level of bearish sentiment since March 31, the least negative bull-bear spread since March 31. So kind of interesting, starts to line up with what we're talking about here. Also, this tweet by Steph Pomboy, and Google searches for recession have collapsed, because she retweeted this person's, "What could possibly go wrong, comrades? Citi has said its index of global sell-side recommendations is back to peak bullish levels last seen 2000 and 2007, after which global equities halved." So again, kind of a reading on sentiment in here. And then I'm going to show you some examples of the top 3 weighted stocks in the S&P 500 and what kind of price action they did in the first wave down: Apple, Microsoft, Amazon. But before I do that, I want to show you this little tweet by Sven Henrik, and I'm probably butchering his name. A little bear market history. He's talking about when the GDP hit a then record 150% to market cap to GDP of 150% in 2000. He's talking about how the NASDAQ 100 dropped initially 40%, rallied back 43%, and then collapsed 83%. So, you know, this is a perfect example of what can happen and of course, that was the 2000 to 2002 bear market. And of course, we had the 2007 to 2009 bear market. Let's take a look at that. I want to start off, I'm going to look at Apple, Microsoft, and Amazon. As everybody talks about how, well, you know, we've rallied back 50% on the S&P 500. Let me pull this back up. Let's just look at this right here. This is what we're talking about. How we've come back and we've retraced at this point 54.5% of this move down. Okay, and I've already talked about how these counter trended. I'm talking about of this move. So of the move, the key thing is, once we reached bear market, quote unquote, what everybody calls bear market territory. I don't agree with the labeling that just because something's down 20% is a bear market. I don't think of the 1987 crash as a bear market. I mean, it was a very quick crash, but you know, it was down 22% in a day. So here we have minus 24%. So once we reach the minus 24%, now we've retraced, and we've retraced 54.5% of it. We'll see what happens. It's really interesting. I've already talked about, you know, the kind of moves that happen here just between this move down here, the retracement that we had, and then the same thing that we had with this next leg down right here, the kind of retracement that we've had. Very, very similar in terms of the moves. But let's go back and take a look at 2007, to look at that 2007 to 2008 first major leg down and what happened here with Apple. Now, first, before I do that, let's just show where Apple is right now. Sorry, a little confusion. Apple did achieve a greater than 20% down at the mid-June levels, right? Down 29.5% at that low, intraday high to intraday low. And we've now retraced 80%. Well, let's go take a look at the 2007-2009. Okay, I showed this last week. I showed the move down and the move back up just to say, you know, yeah, Apple can retrace a heck of a lot. But I really didn't. I don't think I put the numbers on the chart. So I just wanted to show you that, you know, Apple's move down that occurred actually not from October, but from December 27th, it dropped 43.2% intraday high to intraday low. The rally back, 87.9%. 87.9%. Then it collapsed. Well, you know, we've retraced. Where are we now? I just said we're at 80%. So I find that really, really interesting. Yeah, Apple has a tendency to do these very deep retracements and then turn around and collapse with the market. All right, let's take a look at Microsoft. And by the way, before I go to Microsoft, let me go back to this. The reason I'm talking about these three again, right, is because in my mind, I'm thinking of the fact that these three stocks make up almost 17% of the weight in the S&P 500. So if these stocks can achieve the quote unquote minus 20% plus and then retrace deep and then still collapse, what makes you think the S&P can't? Okay, so let's take a look at Microsoft. Okay, so let me talk about Microsoft real quick. What I'm showing on the screen, here's the first time Microsoft achieved the minus 20%, okay, down from high. Intraday high, November 21st, to intraday low in March, is when it first got the, quote unquote bear market type of percentage move, okay? It didn't take all the way to June. It did it in March, and then it rallied back. What did it retrace? 57.7%. And then the next leg down, it dropped another 23.6% from the top in March to the low in June, and then now at the high so far, retraced 67.7%. So that's why I'm not showing, the move from all the way down here to June, because the first bear market marker was achieved right here in March 8th, on March 8th. All right, let's go back in time and let's take a look at 2007 to 2008. It first achieved greater than 20% down at the low on March 3rd. It rallied back. In this case, it only got 49.2%. So this is the only situation of these three stocks, the only one that did not do a 50%. And by the way, I went back and looked at 2002. I just don't want to take the time to walk through all of those for 2000. It did retrace back in 2000. It retraced 84.5%, then collapsed. So anyway, this is what happened at the high for Microsoft. Now let's take a look at Amazon. Okay, similar to Microsoft, okay, Amazon declined and achieved greater than 20% down from the peak back in March. Okay, it didn't take all the way to June. It happened in March. And we're coming off the peak that was achieved when? July 13th of last year. Okay, so it came down minus 29.2%, intraday high to intraday low, rallied back very sharply, retraced slightly over 2/3 of that loss, and then rapidly collapsed down here. And then down 40.7% from that peak, and now has retraced 62.3%. So here we are retracing about the same in terms of percentage retracement. Let's go back and take a look at the high back over here in 2007, 2008. And here we are coming off. This is all split adjusted numbers, just like on Apple. Everything is split adjusted when you go back and look at history. Okay, so from the peak in October to a greater than 20% down move that happened in March of 2008, down 39.4%, bounced back, retraced 76.9%, and then collapsed. So yeah, it's if these can do it, as clearly we're showing, we're going to see it in the S&P 500. I really believe that's exactly what's going to happen. So let's go back and take a look at the SPX. So here's where we're sitting today. Then see what happens. We'll see how much longer this wants to continue to push up in here into this the resistance zone I talked about, and then reverse back down. We'll go from there. By the way, Google also, I was looking at Google. I didn't have data back into 2000, but I looked at 2007, 2009. Google makes up 2.2%. It's like the fourth biggest, I believe, or maybe the fifth. Tesla wasn't trading back in 2007, 2008. Google was down almost 45%, then retraced 57%, then collapsed. So, yeah, I think if these big boys can collapse, the S&P 500 can collapse. So we'll be watching. Everyone, I hope you felt the video was helpful. If you did, give it a thumbs up. If you're not a subscriber to the channel, hit that little subscriber button. And if you'd like more of this information on a regular basis, head on over to joehenches.net, check out the website, check out the membership. Everyone have a great week. We'll talk to you on the next video.